Hi all, thanks for tuning in. In this video, we're going to talk about basic option trading strategy. So this video is especially for the new trader who really wanted to understand what is the option. When we trade the option, what does that really mean? So without further ado, we're going to start about basic option trading strategy. So let's start on the what is an option. So what is an option? So option is a right to buy 100 shares or sell 100 shares. It sounds interesting because you're gonna buy 100 shares and buy 100 and sell 100 shares. So option is intangible right bought or sold by a trader to control 100 shares of security. It expires on a specific date in the future. So basically, option is nothing but a contract. So there are four feature for this option. One is it relates to the specific stock, means you can buy an option of particular stock. Second thing, it's right to buy a call or sell a put. So every option has 100 shares or 100 shares. So what that mean, right? So it's like you can buy one contract and which will give you right to buy 100 shares if particular stock price reaches to the particular range. So next one is a specific strike price. What is a strike price? So strike price is the basic fixed price at which the option can be exercised. So that is called a strike price. Yeah, I know, guys. You're gonna get little. You are little thinking about what is this. It looks complex, but believe me, at the end of the video, I will tell the one-line definition what is an option, and that will be really helpful, you guys. So every option has a fixed expiration date. After that, the option is worthless. Okay, so let's move on. There are type of option. So basically, there are two types of option. One is call and put, and there are different concept for the calls and puts. But we're gonna talk about just naked calls and naked put. So if you see that I already explained, this is an obligation to buy 100 shares of stock when you buy a call. Option can be bought for long term as well as short term position. When you sell an option, you grant the option right to person to on the other side of the trade. So basically, there are two types of options like this. One is call and another is put. Now, for example, I would like to show this is an 3D Ameritrade screenshot. I'm going to make another video on that, like how do we set up. But in nutshell, let's say my Apple price is right now trading at, for example, 135, no 142, right? So if you see this one, this is an option. So you can see there is a 7th October expiry for that particular option. So and this side you can see all calls, and this side it's put. So you can see here it's a call and it's a put. So for example, let's say, and it has so just think about that. So the option is nothing but contract. So these are the different contracts. So what actually we are trying to say here is, let's say if you are, let's say Apple is trading at, I don't know, maybe 135 right now. Let's say if you, what you are trying to say is that now 7th October is coming week, right? So what you are trying to say is when you buy a 140 option, like what you are saying that strike is a 140, it means you are saying, you are thinking the market will reach 3% in this week, and that is the reason you're going to buy the call. So what is the price for that call is $238. So you are going to spend $238. That is your price, and you are seeing in this week Apple will hit 140, and that is from current price it should go 3%. Okay, so let's say what happened if you just let's say you buy a contract on, for example, Monday, when the Monday market is going to start. Let's say Apple moves like 1%. Okay, now this contract price will definitely change because the difference between reaching to the 140 is now 2%. So then this price will might go to like maybe $3 or $3.20. So you will get $100 profit. But as a day trader, right? We are not gonna wait till the Friday that Apple will hit 140 and then we'll sell it. So what we're gonna do is we're gonna sell as soon as we get like 20% profit. So when it reaches to $300, we're gonna sell it, and that is how you will get a profit on the call. So similarly, in the other hand, there is a put option also. The same way it will work. Like you are thinking that okay, if I buy this 135 per strike rate, what I'm saying is that Apple will go down 3% in this week, and I'm buying the put. I'm paying $200. Let's say Apple goes 1% down. So this $2 will become a $3. Like, so it become a $300, and where you get $100 profit. So this is how you book the profit. But what happen if the things goes reverse? Because this market, this trading itself is a very risky play. So what happen if the reverse things happen? Let's say you for example in case of call, when we spent $238 and bought 148 put a call. What happened? This Apple goes down further down for maybe 1%. What will happen? So in that case, you might lose the $100 here. This price will go down to the $138. The reason is the break-even price is now going to be 4%. So just and you can see, let's say for 4%, it's coming around $1.6, right? So that's a $168. So similarly, so only thing is here, like even though stock moves 1% in an option, you will get 20 to 30% profit, and that is the trick. So that's the reason this is very risky. If this goes the other way around, you may lose the money. But we can see how can we control that and what are the different parameter and the strategy we need to use. So further ado, let's move on to the next topic. So the strike price, as I explained, the strike price is here. It's a $140 means we are saying that that particular stock should reach to the 140, then that is called a strike price. So there are different strike price. You can see 144. If somebody knew that, okay, this is gonna go, there is some good news is gonna come. Apple is having some events, and he's going to disclose that they're gonna sell a good product, and there will be a lot of feature going to add for the iPhone. So that might sure if somebody knew that, then he can buy this strike price that is 144, which is coming just $100. And if it is reaches to the 5%, this will become maybe $7. So it's like 700% profit you might get. So this is always a risk and reward. So that's called the strike price. It has different strike price. Strike price is a simple definition. We can say that this Apple is going to reach that particular price is called the strike price. So that is our future price. We are predicting the price. Okay, that's called strike price. These are the things that definitely you can go through this. The option strike is the fixed amount per share at which the option can be exercised. Okay, it sounds interesting, but we are not going to exercise that any contract. Our strategy is just simple. You buy the call, you buy the contract. As soon as you hit your 10% loss, you sell that contract. So simple. We're going to make it very simple. Yeah, expiration is the specific date you are trying to say here, as you see in this slide. What I'm saying is on the 7th October, this should reach to 140. So that is called expiration date. So I am giving the expiration date for that. Okay. Uh, yeah, same thing option, and there are number of strategy for option trading. They have like covered call, covered put, then there is a straddle. So yeah, there are butterfly. There are a lot of things, but we're gonna make it very clean and neat. It's just by call and puts. If you think market is going to go up, you buy the call. If you think market is gonna go down, you buy the put. The market and a overview. Options are very versatile trading device. They can be very high risky or very conservative. You can use calls or puts or combination of both. You can use long or short position or combination of both. So options are too complex for a typical trader. This is not easy to. You need a lot of learning curve. You should know that. You should get those feeling that the intuition should develop that this price stock is going to go up. So there are a lot of things. So best way to learn this option trading strategy, just you have the paper trading. That's a good way to start. What is mean by paper trading? I'm going to have a detailed video in the next session. But in just one liner, the paper trading is where you don't have the real money. It's a dummy money, but on the real market. So you can do the trading with your dummy money, but on the real markets. So this will be like you can say in cricket, it's a net practice. So that is what called paper trading. So now the last slide. In nutshell, what is the option? Okay, for a day trader or scalper like me, option is a just and contract like a stock. Let's say you are buying a stock for $100. If it is goes up, if the stock goes up, your contract price will go up. If your stock goes down, your contract price go down. But only variation is your contract will be vary by 30 to 40% even though your stock moves 1%. So just a think of that. It's just a stock. Don't worry anything else of any complexing, exercising, covered call or nothing. Just think it's a plain stock. Thanks for tuning in, guys. If you like my video, please subscribe and like the button. We are gonna come with the more videos. I'm gonna show my daily strategy on what basis I am trading. I'm gonna show my profit. And thanks for tuning in. Please let us know which video you wanted to see in the comment section. Thanks for tuning in.